Today, I will introducing our report and credit risk assessment technique in Islamic banking. First, let's understand what credit risk mean. In simple terms, credit risk is the chance that a borrower might not pay back the money they owe to the bank. This risk is a major concern for all financial institutions, especially banks, because it can affect the stability and the trust of their customer. In Islamic banking, managing credit risk is even more important because it is not just about profit, it is also about following the rule of Sharia, which forbid interest or riba and encourage fair dealing and risk sharing between the bank and its client. This means Islamic bank have to look at more than just numbers. They need to assess whether a client is ethical, trustworthy, and following Islamic values, along with checking their financial streak.
I will now explain about the concept of credit risk in Islamic banking. Credit risk in Islamic banking is a critical issue that extends beyond loan default and involves potential loss due to the counterparty's failure to fulfill their contractual obligation within Sharia-compliant contract. This risk is primarily influenced by the specific Sharia contract implemented as it involves the failure of one party to fulfill their obligation, impacting the bank returns on investment. Difference between credit risk in conventional bank versus Islamic bank. Islamic banking operation differs significantly from conventional finance institution, leading to significant differences in credit risk perception, measurement, and management. Conventional banks primarily lend money at interest, while Islamic bank use asset-backed or partnership-based financing. They engage in selling goods at a markup, leasing assets, or participating in profit-sharing agreement. The risk is linked directly with the borrower's ability to repay both principal and interest. Conventional lending primarily transfer credit risk from the borrower to the bank, while Islamic finance involves risk sharing between bank and the client. However, most Islamic banks prefer murabahah, which is less risky but not fully aligned with the true spirit of risk sharing. Management of non-performing assets differ between conventional and Islamic banks. Conventional banks classify loans as non-performing loans (NPL) and make provision for potential loss, while Islamic banking use non-performing financing (NPF) to assess problem asset. Late payment in murabahah or ijarah contracts cannot be based on compounding interest model. An alternative mechanism like charitable penalties are sometimes employed to discourage defaults. Collateral and guarantees are permissible in Islamic banking, but Sharia impose restriction on the type of asset eligible for the use of as collateral. Islamic bank often rely more on the business potential of the financial project and the integrity of the counterparty. Our role in shaping the credit risk understanding. Sharia is a fundamental framework in Islamic banking that influences credit risk management. It defines financing contract, prohibits interest, excessive uncertainty, and gambling, and influences the financial instrument available to Islamic banks. Sharia promotes ethical and responsible financial practice, encouraging true due diligence and avoiding speculative or exploitative transactions. It also introduced profit and loss sharing (PLS) through mudarabah and musyarakah, reflecting the Sharia principle of genuine partnership and shared destiny. The lack of interest-based penalties for default forced Islamic bank to seek alternative method for repayment and addressing delinquency, such as restructuring arrangement, grace period, or non-punitive penalties. Islamic financial regulatory organizations such as the Islamic Financial Service Board (IFSB) and the Accounting and Auditing Organization for Islamic Financial Institutions (AAOIFI) establish prudential standards for risk and capital management that comply with Sharia principles, aiming to standardize practice and maintain the stability of the Islamic financial system while adhering to its principle of the Sharia.
Did you know Islamic bank assess credit risk without using interest-based loan? Instead, they rely on Sharia-compliant contract like murabahah, where the bank buys an item and sells it to you at a profit. The risk, whether you can repay. Then, there's ijarah or leasing. The bank owns the asset and you pay rent too. But if you miss the payment, the bank carries the risk too. And Also, in Murabaha, the bank give you a capital to run business, no guaranteed return. So they assess your trust, experience, and business plan carefully. And in Musyarakah, the bank becomes your partner, which is you both sharing profit and loss. These contracts demand more than numbers. Islamic banks assess your ethics, the business reliability, and your Sharia compliance. That's credit risk, the Islamic way.
We will briefly explore the fascinating world of credit risk assessment in Islamic banking. It's a field where financial stability meets Sharia principles, and it is quite distinct from conventional banking. First, let's talk about qualitative techniques. Unlike conventional banks, Islamic banks place a huge emphasis on character. We are talking about trustworthiness, ethics, and crucially, Sharia compliance. Before any financing, they will meticulously assess the borrower's moral background, often through interviews and reputation checks. They also scrutinize the business itself. Is it Sharia compliant? No gambling, no alcohol, no interest-based activities. And they will conduct thorough project viability studies to ensure the business is sound and sustainable. Moving on to quantitative techniques, Islamic banks use adapted credit scoring models. These are not just about numbers, they integrate ethical factors like consistent zakat payments and avoiding forbidden activities. They also heavily rely on financial ratio analysis, looking at liquidity to ensure short-term obligations can be met, and leverage to understand debt versus equity. Repayment capacity is rigorously analyzed through cash flows, always ensuring it's not from interest-based earnings. And while interest is forbidden, Sharia compliant collateral and guarantees like kafalah are used to mitigate risks. Finally, for risk management support, Islamic banks utilize internal risk departments. These departments are crucial for tailoring risk evaluation tools specifically to Sharia principles, maintaining client database, and conducting rigorous stress testing. They also leverage external credit rating agencies that specialize in Islamic finance, ensuring a holistic and Sharia compliant approach to managing credit risk. All these elements work together to ensure financial stability within Islamic banking.
Assalamualaikum and hello everyone. My name is Izzati Ilya and today I will explain the challenges in credit risk assessment in Islamic banks based on our group's topic on credit risk assessment or credit evaluation techniques. So, credit risk assessment is the process of evaluating whether a customer can repay financing. For Islamic bank, this process is more complicated than in conventional bank because it must follow Sharia principle. Islamic bank do not charge interest, so they cannot use the same risk model as conventional banks. This is the first challenge. Most risk models are designed around interest-based loan, but Islamic bank use contract like Murabaha and Musyarakah, which are based on trading and also partnership. So, because of this, Islamic banks need their own models that follow Sharia rules, but these models are still undeveloped. So, the second challenge is the lack of standardized frameworks. Each Islamic contract has different risks. For example, Murabaha is safer while Musyarakah involve business risks. Since each product is different, Islamic banks cannot use a one-size-fits-all method. This causes inconsistency between banks, especially across different countries. Another big issue is the lack of reliable data. Many Islamic banks are still new and they don't have a long-term records of customer payment behavior. Without good data, it's hard to build accurate credit models, especially for small businesses or customers without formal financial history. Regulatory differences are also a challenge. Not all countries apply Islamic finance rule the same way. Some have strong Sharia guidelines, others do not. This makes it hard for Islamic banks to follow one standard approach in assessing credit risk. Lastly, many staff members in Islamic banks do not have enough training in both finance and also fiqh muamalat. This knowledge gap affects how well they can assess the risk according to Sharia. On top of that, economic and political instability in some countries adds more difficulty when evaluating a customer ability when they want to repay.
So next, I will presenting the best practices and recommendation for credit risk assessment in Islamic banking. So to improve how Islamic bank assess credit risk, there are 4 recommendations that we suggest. First one, Islamic banks should develop credit evaluation frameworks that are specific to Islamic contract, such as murabahah and mudarabah. This contract involve profit sharing and asset backing. So banks need to evaluate not just repayment ability, but also business ethic, project risk, and compliance with Sharia. Second, banks should improve the use of technology, especially Sharia compliant financial technology tools. For example, using AI for credit scoring or blockchain for contract transparency can make the credit process faster, more accurate, and more secure, as long as it follows Islamic principles like avoiding riba and also gharar. Third point, we recommend staff training in both finance and fiqh muamalat. This helps ensure that those making credit decisions understand not just the numbers, but also the Islamic legal rulings behind each product or contract. With better knowledge, decision will be more ethical and Sharia compliant. Last point, Islamic banks need to strengthen internal control and create a risk-aware culture. This means having clear rules, regular audits, and encouraging transparency at every level. With strong governance, bank can reduce the chances of credit default and operate with greater trust and stability.
To conclude our presentation, credit risk is one of the most important issues that Islamic bank need to manage properly. Unlike conventional bank, Islamic bank face different kind of risks because they follow Sharia principle like avoiding interest and promoting ethical and risk-sharing financial practice. We have seen that Islamic financial contracts such as murabahah, mudarabah, and musyarakah come with the unique risks. This requires Islamic bank to use credit assessment tools that are not only financially effective but also Sharia compliant. At the same time, Islamic banks still face many challenges. Some of these include a lack of standardized risk model, limited data, and not enough trained personnel who understand both financial and Islamic law. But there are also opportunities with the help of technology, better training, and strong internal control. Islamic bank can improve their credit risk assessment system while still staying true to Islamic values. In the future, as Islamic banking continues to grow and go digital, we believe that developing stronger, more innovative, and Sharia-compliant credit evaluation method will be key to building a more stable and trustworthy financial system. That's all. Thank you from our group.